The deficit, he's been talking about it for years and years and years. Laurence Kotlikoff, Boston University. Good noon, sir. How are you today?
Doing fine, thanks.
Good. Well, our deficit isn't. 04, the deficit. 05, the deficit. 2012, 06, and on and on and on. Why have we waited to 2011 to confront the deficit? What took so long?
Well, we're really engaged in a long-term Ponzi scheme of taking from young people and giving to old people. And we have these fights between the Democrats and Republicans, and that's just a sideshow for what's really going on. So there's really no desire by older generations to make sure that the next generation's protected.
Do you have,
so that's the real problem.
Do you have, with all your academic research, Professor, a tipping point, a handy number, a handy guide that will show us when the crisis clicks in? Is it debt to GDP? Is it the total debt size? What's the measurement you most focus on?
Well, I'm looking at the long-term fiscal gap, which is about $202 trillion based on the CBO's long-term forecast. And if you want to look at debt to GDP, any indicator is going to show we're heading to a crisis. The debt to GDP ratio will exceed 90%, which is the Reinhardt-Rogoff criteria for going critical. That's going to happen in 2017 based on the latest CBO numbers. That's just 6 years away. But I think we're going to have a bond market crash any day now. I don't think we're going to wait 6 years for the rest of the bond traders to wake up to what Bill Gross has said, which is it's time to get out of bonds.
When you say a bond market crash, we assume Fisher rule, higher inflation, or vice versa. I can't remember which. But with that, is it inflation? Is it the Walter Heller inflation of the 60s and into the 70s, or is it a lower but still important level of inflation?
No, it's the Weimar Republic. Print money to pay your bills because the spending is sky high and the taxes are too low to cover the spending. And at some point, people realize that the debt is going to be paid back in watered down dollars. So they stop. You know, it's the same thing you're seeing in Greece and Ireland and Portugal right now. The bond market will crash, interest rates will skyrocket, and then we'll be off to the races. The only thing the government will be able to do is print money.
Bring up dreaded first chart here. Larry, let's bring up dreaded first chart here. Okay, it's total debt. We've showed this before. And Larry, what I would point out, given your immense caution mentioning Weimar Germany, is the glide path here. There's a slope, and then there's another slope out to 2008, and then there's a new slope. Can we staunch the new slope by economic growth? Can that help us get away from the gloom and the caution you face?
Not really, because we've had economic growth for 40 years, and the situation's gotten worse and worse because we're letting our health care benefits and Medicare and Medicaid, and now I'm sure with Obamacare, will grow much more rapidly than per capita GDP. That's happened for 40 years in a row. The differential growth rate has been 2 percentage points. So if you go, there's a way to get out of this, starting with health care reform. If you go to thepurplehealthplan.org, thepurplehealthplan.org, you'll see a solution for how to fix the healthcare system, which 5 Nobel laureates have signed up for, and hundreds of other people from the medical community, economics community, all kinds of communities are endorsing.
What interest rate?
That would put a lid on our spending at 10% of GDP. Our federal spending would just be, government spending would be just 10% of GDP on healthcare going forward. And that would eliminate about 60% of this $200 trillion fiscal gap.
I'm curious what interest rate on the 10-year yield or the 2-year yield where you suggest a real debate will occur. All the emails I get suggest where's the grown-up debate? You've been part of this. There are those that agree with you that are part of it. But when do we enter a grown-up debate politically? What yield?
Well, unfortunately, it might be a 10% yield on short-term paper like the Irish are now facing. It may take that kind of a crisis for the politicians to really do something. But the real danger here is that they're going to continue to do too little too late. If you look at Social Security, our Social Security problem, our unfunded liability there is bigger than it was. I mean, we have a bigger Social Security problem now than we did in 1983 when Greenspan was supposed to have fixed this problem with his commission. We need a bigger tax hike now than we did back then. And we've already had lots of, things that have cut benefits along the way. So they look too short term back in '83. They only looked out 75 years. We now have 28 years that they didn't look at, that we're now looking at in the current 75-year projection.
Right. Larry, if we look at the Congressional Budget Office and the plugins, there's a big, long formula and things that we try to guess into the future. Tell me about our guess of our output, our economic growth, our GDP. How certain can we be of our forecasts? And if we get 3.7% real GDP instead of 3.2, does that take you away from your immense caution?
Well, if you get some fast enough growth and you get a lid on the spending and you don't let it grow as rapidly as GDP, well, yeah, you can outgrow it. But that's a very optimistic scenario. The CBO is making a pretty optimistic scenario as it is, a forecast about GDP growth and also about federal spending. And things look just terrible. Debt grows out the wazoo over time. So you go past this 90% to GDP barrier, and then you crash through that, and it just keeps rising, 300% by 2030.
Let's leave it there. Professor, thank you so much. Laurence Kotlikoff, folks, from Boston University.